morning, everyone, and welcome to the National Association of Affordable Housing Lenders Policy and Practice Conference. It's really wonderful to be together, to see so many people I haven't seen in the flesh in many years, and to meet new people who are here. I hope that we come away from today, from our time together here, with renewed energy for our work, which is very important in affordable housing and inclusive neighborhood development. A little bit about our day. I'm sure that you've seen the agenda. We have our leadoff speaker here, which I'll introduce, Chris Herbert from the Joint Center. We have Adrian Todman from HUD. We have some time for networking and some other breakouts. We've got some very good panels, and I hope that you will be engaged and enjoy the day. So I'm Merilyn Rovira from the Community Development Trust, and it's my pleasure and honor to serve as the chairman of NAAHL. It is also my pleasure to introduce our leadoff speaker, Dr. Chris Herbert, who's the managing director of the Harvard Joint Center for Housing Studies. Widely known, read, and quoted by many in this room, Dr. Herbert oversees the development of the center's annual report, The State of the Nation's Housing, and the biannual America's Rental Housing Reports. More about Dr. Herbert's work can be found in the conference materials or on the app. We've invited Dr. Herbert here to help us understand today's affordable housing crisis and to give us facts and trends that may help shape our work. Dr. Herbert, welcome, and thank you for joining us.
Well, good morning, everyone. It's so nice to be here in person. There's a lot of familiar faces that I haven't seen in a long time, so it's really great to be here. Thanks, Buzz, for the invitation. So what I'd like to do today is kind of set the table for some of your conversations, and I always feel a little self-conscious coming to a group like this, which is a group that really knows the story, but hopefully, as Merilyn said, provide some facts and figures to help inform your telling of the story as well, and maybe provide some new insights. So the key points I want to hit, I'll give you a roadmap of where I'm going to go. Given the nature of the Joint Center's work, I'm going to run through some data, but here are the big points I hope you come away with. One is that tight supply has really been a key driver of our housing affordability challenges, but not really as well recognized has been that demand has also been growing really exceptionally strongly, and so it's that combination of strong demand against tight supply that has really been driving the affordability issues. Talk a little bit about how the Fed actions are starting to slow prices and rents, but also probably going to have a negative impact, or will have a negative impact on supply, which is in the long run not going to help us, since what we've been having is a supply side issue. Talk a bit about affordability and how the rise in interest rates we've seen are really locking renters, millions of renters, out of the homeowner market, and then talk a bit about affordability, which is the key point of the story, and close with just a few of my observations about what this suggests about where we need to go from here. All right, that's the roadmap. So here's some of the data. So the way we look at the housing supply issue is we compare, very simplistically, the housing that we're added to the housing stock compared to the number of households we're adding to the overall country's population of people living in housing units. The green line is housing units there over time. How many are we adding? So this is completions plus manufactured home placements. And then the blue line is, the dark line there, is household growth. And you can see this goes back to the 1970s. We always are adding much more housing than we're adding households because we're replacing existing housing. Housing unit gets old, gets demolished, gets replaced, and so you have to have about 20% more housing units than households in order to be keeping up with that demand. You can see that during the times of recession, that line of housing completions comes down. It might touch household growth, but then it bounces back up. But over the last 10 years, in fact, we've been having those lines be coincident, which means we're just adding as many housing units as we're adding households, which doesn't allow for the fact that we're removing housing all the time. And you can see there the purple line over the last year or two has actually gone above the housing supply line. So we've been in a period of tight supply for a while, but that over the last couple of years, household growth has really taken off, which has made that problem even worse. A little bit more about supply. One of the key attributes of the supply that we're having is that it's actually bigger housing than we've had in the past. And mostly what it is we're not building starter homes and we're not adding smaller homes that we need to be able to have more affordability and for smaller households. So the top line here is showing you the number of housing units added each year that are over 1,800 square feet. And that yellow line, which I need to make bolder given its importance to this story, is the number of housing units under 1,800 square feet that we're adding. You go back to the early 2000s, we're adding about 800,000 large homes, about 400,000 to 500,000 small homes. And then during the boom, the housing boom, we added a lot of big homes, but that we kept building those small homes. What you've seen is since we've done the recovery, that small home market has not come back. We just don't build small single-family homes like we used to. And we've been seeing all the growth in the single-family market has been among larger homes. So we're not only not building enough homes, what we're building more of are larger homes. The other lines on here are other potential sources of supply that's smaller and more affordable. Manufactured housing, where in the 1990s we were producing 200 or more thousand units a year. That market crashed and has been very slow to come back, now just getting back to 100,000. And condos also is an important part of the market that we expect to see more of and have seen less. So not enough supply, and particularly not enough supply of smaller homes. Again, against the backdrop of increasing household growth. So this chart is showing you the annual average gain in households going back to the early 2000s. So during the early 2000s, we added about 1.4 million households a year. We expected that, given the demographic profile of the country, that should have been trending down to about 1.3, 1.2 million. But then you can see during the bust and the aftermath, household growth fell to about 600 to 800,000 a year, which is anemic. And the reason why it fell so much is mostly because young people were not moving out on their own. They were staying home longer. They were going to graduate school and college longer. They did move out. They tended to move out into more large groups. Also, people facing affordability challenges were more likely to double up. So for all those reasons, household growth fell to a what I would describe as an anemic level. By the late teens, we saw household growth now has got back to about 1.2 million, which is what we expect the demographic profile would support. But you can see then, since then, it's actually gone up to 1.8 million, and we think based on the latest data, it's almost approaching 2 million a year, which is really kind of astronomical amounts of household growth. Part of this is pent-up demand. So those kids in our basements ultimately do move out, I can tell from experience. And in fact, and then during the pandemic, what happened is they moved out into group household situations, but now they're working from home, and so they all split up. And so household formation was really, at first was hurt by the pandemic, and then was really goosed by the pandemic. So we have household growth of about 2 million a year, again, against that backdrop of tight supply. The other thing about this is the demographic profile. So here I'm showing you the average growth in households in the early part of the 2010s and the latter part. And the two groups that I circled are the ones I want to pay most attention to. Those 35 to 44 account for most of that increase in household growth. And that's the kind of delayed household formation until people get into their 30s when they really start to move out on their own. And then continued growth on older households. So we're seeing a lot of demand coming for groups that we would normally expect to be in a home ownership phase of life. The other key aspect of this growth, particularly on the rental side, is that this is showing you similarly the profile of renters in 2009 in the orange and then 2019 in the yellow by income. And you can see where those yellow bars are going beyond the orange bars. That's where household growth has been strongest. And it's been strongest among renters among those making more than $75,000 a year. So we're seeing all this growth in rental demand. A lot of it is among higher income renters, which is pushing up rents across the board, particularly when you factor in we're just not building enough housing. And that's partly because those groups have also been delayed going into home ownership, staying in the rental market with a lot more purchasing power. So overall, household growth really strong in part because of young adults in their 30s and young adults with a fair amount of purchasing power. The other part of the story, obviously, is the growth in investor demand. So this is showing you the share of single-family homes sold to investors as estimated by CoreLogic, running about 15% with some ups and downs over the course of the years leading up to the pandemic, and then shooting up to the high 20s during the pandemic. That big increase in housing prices we experienced, the run-up in rents, all of that provided really strong investment opportunities that added further to the demand in the housing market. So where are we now in prices and rents? So the orange line here is showing you the trend in apartment rents over time and percent change, the annual growth. The yellow line is house prices. We go back to the early 2000s to kind of put in perspective what we saw in the last few years relative to the housing boom. And so we had housing prices growing at 20% nationally, which is well above what we saw during the boom. Apartment prices or rents were going up at 10%, which is levels that had never really been seen in any of these data. And the key thing there, too, is if you look at it, it makes those recent booms make the last decade look like a fairly period of modest gains, but those were steady, large increases beating inflation. So we've had a long period of time where house prices were going up at a steady rate above inflation and then just went through the roof during the pandemic. You can see the Fed's effect is being felt. House prices are rapidly slowing, rents are rapidly slowing, but on a year-over-year basis, they're still strongly positive. But the direction there is quite clear where they're going. As I said in my opening framing of this, the issue I'm concerned about is that while we absolutely needed to throw water on that fire of housing prices, if the way we get there is by dampening down supply, we're ultimately just going to make the underlying problem worse in the long run. So if you look at what's happening with housing starts, this is showing you long-run trends in single-family and multifamily starts, single-family on top. The lines on this chart show you the long-term average going back to 1990. So single-family starts have typically averaged about 1 million. Multifamily starts about 350,000. And what you can see is coming up into the pandemic, the shortage of supply and that kind of grand scheme was heavily concentrated among single-family, which was running well below those long-term trends. Multifamily was above trend. Made sense given the demographic profile of the country, which was people in their 20s mostly piling into apartments and not really moving into home ownership. But then during the pandemic, single-family starts went well above 1 million, got to 1.2 million, which was a healthy rate of addition, something that we needed. But you can see with the impact of the Fed, those single-family starts are now down below 1 million, about 800,000, and likely to continue to fall. Meanwhile, multifamily starts are staying up. They're actually been trending up over the course of this year. And it partly, again, it reflects the fact vacancy rates are at historic lows. People are being blocked from moving into home ownership, have to go somewhere. They're upper income renters. They're still in that apartment market. So for now, the multifamily market is still holding up in the face of this strong demand, particularly since owner-occupied demand is being tamped down. But I do worry, it'd be interesting to hear the conversation from folks in this room about how much more multifamily can pencil out, even if rents are holding up, given the fact that interest rates are 7%, and investors may be pursuing different rates of return as well. So I don't expect multifamily starts to defy gravity forever, but for right now, they are. Let me talk a bit about home ownership then. So this chart is showing you home ownership rates by race, with the white rate in orange, and then African Americans in gray on the right-hand side, Asians, Native Americans, and Hispanics in those middle bars. And we're showing it to you by income bands of area median income, because one big factor in racial disparities in home ownership rates is the fact that African Americans and Hispanics in particular have been subject to a long history of discrimination that affects their ability to earn incomes in the market. That will help pull down their rates. But even if you control for incomes, those gaps are significant, particularly large for blacks in the 50 to 80 and 80 to 120 AMI. But even among those making more than 120% of area median income, the gaps are large and meaningful. So it's in this context, I think, that as we think about what's going to happen to home ownership affordability and how much progress can we make against these gaps, that the current situation is challenging and concerning. But one little aside here, I saw in the paper today, the Washington Post had a piece about home ownership rates in 2021 and touting the fact that there's a big jump in home ownership rates across the board. African Americans had a particularly large jump. The gaps are still really large, even by those estimates, 29 percentage points, black versus white home ownership rates. And I have not yet had a chance to really digest these data. The jump is incredible. Incredible in the sense of being, wow, that's big, but incredible in the sense of, can it really be that big? So we wanted to take a chance to have a look at this before I opine on it. But I think what we've been seeing in other data sources, the housing vacancy survey and the like, suggests that homeownership rates were going up sharply during the pandemic. Obviously, there's a big move into the owner-occupied housing market, but I want to just reserve judgment on how big that is and how much we want to believe those numbers on their face, given the challenges of data collection during the pandemic. But The short answer is there clearly seem to have been gains, but the gains are also been among whites, so the gaps really haven't closed. Okay, that's an aside, but back to the story about affordability. So one of the things we did in our State of the Nation's Housing Report was saying, well, what's the impact of rising rates and rising house prices on the ability of folks to afford a home? In that report, we did April to April. We've updated it now to September, October of last year versus this year. And you can see that with mortgage interest rates going from 3.14 to 7.08, that's just an enormous increase in what the cost of a home is going to be. You add on top of that the big increase in housing prices, and the bottom line there is the income needed to qualify for a median price home in the country went from $83,000 to $125,000. The monthly payment went from $1,500 to $2,500, so a $1,000 gain in the span of a year. This is just an astronomical increase in what it costs to buy a home. And if you look at the amount of cash you need, I think we assume a 3% down loan, you need $25,000 in savings. So between $125,000 in income, $25,000 in saving, it's an enormous obstacle to home ownership for folks. What we did in the report was we estimated how many renters were locked out of that buying homes, given that change in income. It went from about 10.5 million renters in April last year to 5.5 million renters in April of this year. So that was a loss of 5 million renters who could afford to buy a home. And we haven't done the recalculation yet, but it's somewhere south of there at $125,000. So just the door to home ownership has been closed for literally millions of renters as a result of this movement in house prices. And interest rates. House prices and interest rates have been the key part. All right, let me just close with some discussion about affordability, and then I'll open it up to questions. So this is just to start off by showing the share of renters and homeowners who are cost burdened by race. So as we all know, renters have been around 50% of them have been cost burdened over the last 10 years. It's gone up and down. I'll talk about the trends in a second. Homeowners have been about half that. One of the impacts of the foreclosure crisis and the decade following that with declining interest rates was cost burdens fell pretty sharply among homeowners, in part because the worst off folks lost their homes, in part because there were very few first-time home buyers, in part because interest rates came down and helped people ease those problems. But still, about 20-25% of homeowners are cost burdened. But as you can see here by race, the key point is that those rates are much higher for people of color than they are for whites. So housing affordability continues to be an issue, continues to be an issue of racial equity in the housing markets. Let me talk a little bit about the longer-term trends in renter affordability. So this chart is showing you two things: the number of renters who are cost burdened. The orange part is the number who are significantly, seriously burdened, meaning they spend more than half their income on rent. And yellow are those paying 30 to 50% of their income on rent. The line is showing you the share. So the share of renters who are cost burdened reached a peak around 2011 at half of renters. And since then, there's been some gradual improvement, down to about 46% as of 2019 when this ends. The number of renters actually who are cost burdened kept going up through 2014 because the share of people who are renting kept going up. And so even though the rate was going down, the number was going up. And so we're now at a point where it's been pretty flat. The number of renters who are cost burdened has been about 20 million, about 10 million seriously burdened. And so this has continued to be a really significant issue in the market. And we don't have great data on what's happened since the pandemic. By our estimate, in 2020, there was an increase of about 1.5 percentage points in the share of renters who were cost burdened, which is an enormous one-year increase and a big reversal of this trend. But the data collection issues during the pandemic were significant, so we're waiting to dig into that to really understand it more fully. But obviously, with rents going up 10, 15, 20%, greater than inflation, greater than incomes, we only expect this to be a much bigger number going forward as well. Last point about the trends and cost burdens that's really important both in terms for policy, practice, and politics is the fact that even though cost burdens have been coming down overall since the mid-2010s, the rates for people making moderate incomes have actually been going up. So this is showing you the share of renters in 2001, 2011, and 2019, cost burden in different income bands. And the ones that highlighted there on the left is people making 25 to 50. You can see that there has been a significant jump in the share of renters who are cost burdened continuously over time, and as well as for the next group making 50 to 75,000. So what's happened as rents have continued to go up faster than inflation, it's pushed this problem of affordability from just being primarily a problem of the very poorest households to being moderate income households as well. That's led to all kinds of concerns about rental affordability from a broader spectrum of people. It's changing the politics in terms of getting greater support for this issue of affordability, but it's also changing where we're focused. So we're focused not just on the poorest households, we're focused on moderate income households. We need solutions to both, but I think we need different solutions, so we don't want to conflate those issues as we think about what do we do about it. So let me close with just a few observations of my own about what does this mean for where do we go from here. So the first thing is that given that fundamental to our affordability problems is this lack of supply relative to demand, is we need to be conscious of efforts to expand supply across the board. So we need it not just for the lowest income households, but for moderate income households as well. And a number of solutions there point to state and local governments and regulatory relief on the ability to produce more modest cost housing in cities across the country. But it's not going to solve the problem for the poorest households. So we absolutely need to be for policies that are going to help meet the needs of poorest households, and that includes demand-side subsidies like vouchers, but it also means because of the fact that supply is fundamental to this problem, we need more supply of capital A affordable housing as well. I also want to put a plug in for absolute concerted efforts to address racial homeownership gaps of nearly 30% for black households, 25% for Hispanic households, have just enormous consequences for people's wealth and stability, and we really need to have conscious efforts to focus on this. So Steve O'Connor here today from the MBA, it's really interesting work in convergence, trying to take a holistic look at this, which addresses the need for demand side and supply side and informational approaches. So really would love to see more work there. And then lastly, we do need to build on the lessons from the pandemic about what we can and should do to help address renter and homeowner stability and keep people safely and securely housed. All right, not a happy story in many respects, but I'm happy to see all these faces in this room working on this issue because we clearly do need to work on it. So with that, I've got a few minutes, 10 minutes or so for questions. Yes, sir. And Buzz, do we want people to identify themselves, or is there a mic?
You could wait for the mic.
Right here on the aisle here.
And please identify yourself.
Jim Matthews with Capital One. I'm just curious on the supply side. I didn't see much in the presentation, and I'm not sure whether data is even available for this or not. But you talked about a certain percentage of housing needs to be replaced every year. Is there any dynamic within the existing housing stock, especially as it pertains to more money being put into renovation to extend the useful life of housing, or are we seeing more people having to live in substandard housing?
Yeah, I think it depends on where you are. And so I think there's parts of our metropolitan areas where there's not enough investment in keeping the housing that's there up to high quality. And then there's places like where I live in a wealthy suburb of Boston where the loss of housing is not loss of dilapidated housing, it's loss of Cape Cods from 1950s and being replaced by homes 2 or 3 times their size. So some of the investment we need is to preserve existing affordable housing. A lot of what's happening is replacement of good housing in hot areas with bigger and better housing too. So, one of the facts about the housing stock is it's actually older now than it's been in a long, long time because of the fact we built so little housing after 2008. So the median age, I'm not going to remember off the top of my head, of both single and multifamily housing is in the 40s, which suggests an enormous need for investment in maintaining that housing, not to mention the fact that we need to retrofit housing to be both resilient to climate change and to not produce as much carbon. So there's a big need to invest in existing housing to preserve affordability, to make it more climate resistant, and to not lose the housing that we have that's affordable. Other questions? There's one over here. The mic runner is actually literally running.
Hi, Joe Flatley. I'm wondering whether, it may be too early to tell, but whether you've seen data on the locational impact of the pandemic and the fact that people are working from home, their locational decisions may be very different post-pandemic, and how that's affecting different urban, suburban, rural markets throughout the country.
Yeah, I think it is a little early in this. We're always looking in our rearview mirror, data collected a couple of years ago on this, Joe. But I think one thing my observation on the market is that, based on what I described about the supply side issue, is that we have not been building enough single-family housing, and particularly as you think about what the nature of demand was coming out of the pandemic. It was for lower density single-family housing. It matches the demographic profile of where we are right now as a country. We were starting to see that. I think coming out of the foreclosure crisis, there was a real reluctance of builders to go out to the fringe because of the fact that's where everybody lost their shirt, and because of the fact that millennials were at a stage of life where they wanted to be in the city. So given the fact that we kind of started to separate where you live from where you work, some of that's going to mean that people can move to different market areas, but a lot of it's just people moving out within the market area they're in. So I think that there was a push towards doing that, and it was going to help alleviate our supply concerns. But the fact that single-family starts are going through the floor, that's where we're going to see that shortfall in the near term. Obviously, we have to be concerned about sprawl and its impact on climate, but I think with the fact that people are working from home, with the rise of electric vehicles, I think we might be able to have more diverse development in outlying areas without having those negative impacts. So I think that's probably where we're going to go, but right now it's hard to say because the market's being so challenged by the interest rates. This one right here. Here comes the mic runner.
Oh, yes. Julissa Cariello, I'm with Dream On Group. I love this information you're sharing. I noticed you didn't touch on anything on data when we talk about displacement or gentrification. Do you have any data you can share on that?
I don't. And it's really hard to measure displacement. The academic studies that have been done on this tend to find that if you look at lower income communities, there's a high mobility rate. And so in any given year, people are moving in and moving out. And as gentrification happens, what tends to happen is that on an aggregate level, people don't move out as much because the neighborhood conditions are improving, and if they have an ability to stay there, they will. And what it mostly does is deflect people from moving in. And the incomers become more higher income folks, white folks rather than people of color. And it's that dynamic. It's slower moves out of the people who live there, but faster moves in. That's the academic story. And I think it's academics trying to get data on who lived here, where did they go, and where did somebody come from. That's really tricky data to get from the kind of data sources we have. And I tell that story, it happens at a high level, but it ignores is the fact that at an apartment building level, I think we've been seeing displacement of a type that we didn't have in previous waves of gentrification. So I would just say when you look at the academic literature, when I look at the academic literature, always look at the date. And a lot of it is done for earlier time periods when we have the data. And I think what's happening now is that just the nature of investment in modest apartment buildings is so different than it was 10 years ago, where people are able to identify these opportunities for upgrading properties by using big data, identifying those properties, aggregating capital, making those purchases, flipping the properties, and repositioning them in a way that's a different dynamic than we had in previous waves of gentrification. So I think that displacement, people are seeing it in their communities, but we have a hard time measuring it. I don't know if I answered your question or not, but I haven't. I mean, look at the studies I look at, they don't tend to find strong evidence for displacement, but that's at odds with what people see happening directly in their communities. This one right here.
Hi, Breach Farrell. I'm here for ACLI. I had a question on your 65 and older cohort that you said was, it surprised me, the size of the housing.
How big they were?
Yeah, is that because they're selling and replacing with smaller housing and downsizing, or is that actually a
That was
net?
just the number of households. So that one slide that showed that the
formation.
growth in the 35-year-olds, and then
Yes,
that was just overall numbers of households. So it's basically it's the age in the baby boom generation. So there was a stat, I'm not sure it's still true, a few years ago that every day 10,000 people were turning 65. And so it's just a lot of people like me, starting to approach that line, getting ready to cross it, who are entering that age group. One thing I will say is that if we look out 10 years from now, what we're going to see is there's big growth in people over 75, but then we're going to start to see the baby boom generation decline and a big turnover in housing occupied by older folks. But that's not going to happen for another 10 years. But in the next 10 years, we're going to see a lot of people in their 60s and 70s, which is going to slow down the turnover of housing because people are less likely to move then, and kind of further gum up the housing market. But I don't want to ignore that. We have one over on this side of the room as well. And if I got anybody this side of the room, make yourself known. Help me out over here. I don't want to ignore the sides. She's right here. Oh.
Good morning. LaToya Kyle with Low Income Investment Fund. So I entered the community development affordable housing space just after the recession in 2010-ish. And at that time, there was a lot of money being provided to provide support through NSP for home ownership. Has there been any data collection to show the impact of subsidy to the buyer and to the developers in creating new home ownership at that time, and how that could be supported now for the creation of new homeowners?
No, there was an evaluation of NSP that was done. HUD had it done by Apt Associates, who I used to work for. I don't, off the top of my head, recall what the findings were. And I don't know if anybody in this room does. You can maybe raise your hand and help me answer the question. My sense was that NSP was so small relative to the scale of the issue that it was, I mean, there was some attempt in places to concentrate investment and help turn around neighborhoods, and the investments ended up not being that big overall, and it was swamped by the private capital that came in that I think was really unexpected in that was really the rise of single-family investors during that period of time. So I'm not sure what the lessons were from NSP, but I don't think I'd want to look at that as a model. It was really clumsy in the way it got out. It wasn't as big as it should have been. There's the Neighborhood Homes Investment Act that has been floated. Are people familiar with that? Which was an attempt to get capital into distressed neighborhoods to help build new housing and invest in revitalization, renovation of existing housing that I think is absolutely needed. But I wouldn't want to hang my hat on NSP as the proof of that. But do I have somebody on this side at all? Otherwise, I got Priya right here. I'm sorry, the mic runner is like going back and forth. Right here in the front row.
I think your last point was lessons learned from the pandemic.
Right.
I'm familiar with what worked from the emergency rental assistance. What are the big takeaways about what didn't work?
Oh, wow. What didn't work? I think I'm going to focus on what did work, which is a way to maybe highlight what didn't work. I think one of the things I appreciate about the way that program was rolled out was Treasury was really trying to observe it in real time and tweak the rules. And so one of the things that didn't work initially was the challenges people had in documenting their incomes and checking all the boxes to get the money allocated. What did work was giving great freedom to be able to self-attest, to be able to say, that I have experienced these things. I can't find the paperwork right now, but this applies to me. Hopefully we're not going to find significant amounts of fraud, waste, and abuse, which would put a damper on that. But I think the whole system is so geared towards squeezing out waste, fraud, and abuse that it creates roadblocks to getting money out. So I think one of the things the ERA pointed to, I think, was the need to have, particularly in the time of emergency, much greater leeway in making those decisions to be able to be effective in getting it out. The Hardest Hit Fund, going back to the NSP era, was a program I think was plagued by trying to make sure only the deserving got the money in a way that many of the deserving couldn't get the money. So I think that was one thing that's a positive. I think there was examples of a lot more coordination between tenant protections on the legal side and the ERA program and trying to coordinate those things. On the homeowner side, I think the forbearance program was amazingly successful at a very simple way of saying, if you can't make your payments, don't make your payments, we'll solve it later. And it's really been astounding, really, how little the wave of foreclosures there's been. So I don't know, I'm not answering your question. I'm mostly focused on what was positive than what was negative. But
Did any states put out
I don't know that. Did any states put it out in the form of cash? Maybe someone can come up with you at the break. I'm not that versed in what every state did, but one question here. Oh, you got the mic already.
On top of it, Bernadette Muller. Just a question. I was a little surprised when I looked at your one slide of housing starts.
Yeah.
And the condo was pretty much flatline growth.
Yeah.
Any color on that, or?
You know, it's been a bit of a mystery that, you know, with affordability challenges being what they are, with the interest in kind of more urban, denser living, there are places like Colorado where the liability issues for condos are being significant, and I've heard that it really has squelched developers. You know, if I sell you a condo and you come back later and can hold me at fault, then, you know, even though I thought I closed that deal, I have this liability that goes on. And Colorado, I understand, has significant liability issues that have helped really kill the condo market, but I'm not sure that that's true nationally. So I don't have a good answer why it's not gotten bigger. Rob Dietz from the National Association of Home Builders has been saying we're going to see condos and townhouses, you know, development go up because of the fact that that's market's ripe for that. And if you look at what happened in the 1980s, when interest rates were 17%, we had a big boom of condos and townhouses when the baby boom generation was trying to get, my generation was trying to get into home ownership. So I don't know if anybody else in this room has an answer to that, but it's a bit of a puzzle to me as well. I got 29 seconds, so maybe I should close it there. If you have, I'll stick around for a while if you have any other questions for me, but I really appreciate the chance to speak with you. Look forward to hearing the conversation today, and good luck. We got some challenges we need to solve, so.